Hi guys, welcome back to my YouTube channel. Today we're going to be looking at financial leverage. We're going to be going through the balance sheet to analyze the leverage of the organization. When an investor wants to invest in an organization, there are three ratios that they are most interested with. And the first one is the liquidity of the organization. How liquid is the organization to pay back their money that they're investing in the organization? We're giving you money, we want it back together with return. How liquid are you? So that is one of the things that the investor is interested in before they invest in an organization. The other thing is the profitability of the organization. No one wants to invest in an organization that is making losses. Everyone wants to invest in an organization that is profitable. They can even negotiate higher rates of return because this organization is making profit. So the investors will look at the profitability of the organization to negotiate for higher returns. Another thing would be the leverage. What is the position of debt of this organization? No one wants to give a highly leveraged organization funds simply because it's like you're adding debt on top of debt. An organization that is highly leveraged, you're giving more money. This poses a credit risk to the organization because we know debt is the creditor's interest in an organization. So if the creditor's interest is too high in an organization, probably this organization won't be in a position to pay back the debt. So basically, that is what we're going to be looking at, guys, today. So stay with me all the way to the end. This is Mumbua, your future CFO. So basically, guys, we're going to be looking at our balance sheet. And the first rule of the balance sheet is to check if your balance sheet is balanced. The reason why it's called balance sheet. Does your total assets equal your total liabilities plus equity? So that is the first check that you need to do before you start any form of analysis on your balance sheet. Your total assets needs to equal your liability and your equity. The accounting equation. That is the most important accounting equation. Assets equals equity plus liability. So that is the first check. And looking at my balance sheet, it's balanced. My total assets is $1.74 thousand. And my liability, the same thing, $1.740 million. So my balance sheet is good, guys. So we're gonna now start our analysis. So let's dive in. Let's now start the actual analysis. The first ratio that we're gonna be looking at is the debt to equity. And when I talk about debt, I'm looking at the total debt. What is not ours? What belongs to the outsiders? And that is my current liabilities and long-term liabilities. Looking at my balance sheet, my current liabilities is 300,000. And these are the liabilities that needs to be paid within the operating cycle, the current operating cycle. The non-current liability, 630. These are long-term liabilities. So the total is 930. And my equity is common shares plus retained earnings. We know retained earnings is money that belongs to the owners of the organization, the shareholders, profits that we've retained as an organization. So 810, 930 divided by 810, that gives us 1.15. 1.15, that is our debt to equity ratio. And as I mentioned, we have three sources of funds. we have the debt, we have the retained earnings, and we have common shares. The capital structure of the organization depends on the cost of each source of capital. Maybe we are able to raise funds cheaply at a lower cost from debt. Maybe that is the reason why we have more liabilities than the shareholders' equity. But at the same time, as an organization, we need to leverage. We need to make sure that we not over leverage. It poses a credit risk to the organization. So a 1.15 is not a bad ratio, but if we can improve, the better. Yes, if we can improve, the better. The other ratio that I'm going to be looking at is the debt to capital ratio. And when I talk about debt to capital ratio, I'm looking only at the long-term debt, the portion of the non-current liabilities, which is 630 over the shareholders' equity. So that gives me 78%. So the total debt is 78% of the total equity. Are we highly leveraged as an organization? Are we depending more on debt compared to shareholders' equity? As I've mentioned, this depends with the source of each capital. The three sources of capital: there's debt, there is the common shares and preference shares. We will classify them into one. And also the retained earnings. So we need to look at that, how we over leverage as an organization. 78% of our debt is a percentage of the equity. So that's something we need to check. We need to look deep into that as an organization. We know exactly what our policy says, what should be the ratio of debt to equity as an organization. What do we target to achieve? The other ratio that I'm going to be looking at is debt to assets. What is the percentage of our total liabilities to our total assets? Our total liabilities are 930 from our balance sheet, and our total assets are $1.740 thousand. So our total liabilities are 53% of our total assets. So we are relying on 53% debt to finance our assets. We need to check as an organization, what do we aspire to achieve as an organization? What is our debt to equity ratio, our target as an organization? Then we will be in a position to know if we are using more debt to finance our operations. Another thing that could maybe attract a company to use more debt to finance their operation, maybe the interest rates. The interest rates are favorable, and we know that the interest expense, it's allowable for tax purposes. It gives a shield on taxes. We are able to pay less taxes when we deduct the interest before we calculate our tax. But all the same, let's not over rely on debt. We know it poses risk to the organization. So we need to check our policy. We need to check the industry. We also need to check what our competitors are doing. Then we are able to benchmark ourselves as an organization and know the best position as an organization. The last but not least ratio that I'm going to be looking at is the financial leverage ratio from the balance sheet. We know that we can calculate the financial leverage ratio from the income statement. We can also calculate the operating leverage ratio from the income statement. But here I'm looking at the financial leverage ratio from the balance sheet. And this is the total assets over the total liabilities, sorry, over the equity. What is the percentage? What is the portion of equity that has financed our total assets? Our total assets are $1.740 thousand, and our total equity, that is common shares plus retained earnings. Retained earnings is money that belongs to the shareholders, 810. So our equity has financed 2.15 of the assets. So 2.15 of our assets have been financed by equity. That is what it means. The higher the ratio, the better for the organization. If we can finance more of our assets with equity. But this will depend with the cost of capital, the cost of raising equity. We know the cost of the underwriting cost of equity is it's very high compared to other sources of income, other sources of capital, and the reason why it's highly the underwriting costs are high. We know payments of dividend is not an obligation, especially the common shares. You just pay when you make profits. It depends with the company dividend payment policy. So that is the reason why the common shares demand a higher rate of return. So guys, with that said, that is what I had for you today when it comes to analyzing the leverage of an organization. And basically what we've said, the leverage ratio of the organization will depend on how we're leaning towards debt as an organization. But don't forget, you need to watch out what the company policy says, that the levels of debt to equity, you don't exceed, you don't go beyond what as an organization you strive to achieve. So with that said, guys, thank you for your time. Thank you for staying with me all the way to the end. You guys are just the best. Thank you, and don't forget to smash the button. Subscribe to my YouTube channel to get notification on future videos. And together, guys, we're gonna grow strong. Thank you, guys. Be blessed.